What's up, guys? Raymond here, and we're going to be doing our next financial statement analysis video in the series, and this one is for Nordex. I was supposed to release I was supposed to release this video yesterday, but I had something come up, so my schedule was a bit disorientated, so I decided to post it the following day, which is today. So apologize if you guys were expecting this video yesterday, but I'm trying my best to make sure my schedule is more consistent, so I don't have to miss a day. But anyway, let's get into the video. If you guys are new to my videos, what we do in the financial statement analysis videos is to analyze the financial statements, the top three financial statements, that being the cash flow statement, the income statement, and the balance sheet. And when we go through each statement, we kind of determine with some key factors what signifies a healthy business and whether or not that particular company is healthy and whether or not it has a strong future. So without further ado, let's get into Nordex. So we're going to look at the key ratios first. So the market cap being a very important factor, a market cap of over 1 billion in their denominated currency, in this case it being the euro, is definitely a strong factor, showing that the company has lasted or at least overcome a few hurdles to be able to get to a large size, and also is a quite attractive company to its shareholders and also to the market in general to be able to attract that amount of money. The revenue figure is 5.44 billion. So as you can see, the revenue figure isn't the most important element, but it is very important. Revenue is just sales, how much money the company has made in sales in that financial year, in this case being 2022-2023. And there is a large disparity between the market cap and the revenue figure, but that isn't as important as the profit margin to market cap. So let's just look at the revenue to market cap ratio. The ratio. So it's about 4 times so about 4 to 1. So 400%, which is quite high. So we're going to quickly check the yearly performance to see if the market cap has dropped quite significantly, to see why there's such a disparity. So we can see here that the market cap has halved in the last within the last financial year, within the current year. So it should be, if it were to go back to its original price, it should be about 3 billion. So that makes it a lot better, but there's still a large disparity. But that isn't too bad, considering that revenue and profit margin is rarely very similar. Profit margins are usually around 10%. So let's just go into the beta, which is 1.75. So the beta is just volatility level. The average is 1, so that's about the average is 1, so beta here is 1.75, so it's about 175% of the average, which is not great, but it's not the worst. I've seen worse, but it's not great. But considering the current financial climate we're in, I wouldn't say it's a bad thing. It's quite average, actually. So let's get into the earnings per share. So that is profit margin per share. So it's actually negative, which means the company's made a negative profit this year, about 166. Actually, no, that would be wrong to imply that. It's made a negative profit, which is not great, considering that although we are in a very, very tough economic situation, companies that stand out and that do become market leaders are the ones that tend to do well in market crisis. This one doesn't seem to be doing very well, so that is going to reflect negatively on the company. Let's get into the PE ratio, which doesn't show. Dividend yield doesn't show. These are also two very important indicators, and also very important ratios that investors look at when determining whether or not it's a good investment. You can kind of calculate the PE ratio on your own by just dividing the price by the earnings. The dividend yield is very important because we want to be able to calculate the overall return on investment, specifically cash. So this one you can check online by doing independent research, but it is a barrier for investors. So let's get through to the first financial statement, being the income statement. So as you can see here, the profit margin is negative for the past 3 financial years. The profit margin, yeah, so it's negative for the past 3 financial years, which is not great because we haven't had a tough economic climate for the past 3 years. It's mainly been this financial year that's been tough. So that's definitely going to reflect negatively on the company and also deter investors from investing in the company. So let's look at the second of the financial statements, being the balance sheet. The balance sheet suggests that the company is highly leveraged. So I would classify highly leveraged as over 50% debt to asset ratio. Just remember that liabilities, that being debt, specifically debt, does incur interest. So whatever the company makes in profit, or net change in cash, has to be divided up and paid out to investors in the form of dividend. If the company issues a dividend, most companies do, and or has to be allocated to things like taxes and also interest payments. So if the company is highly leveraged, then the company will have higher interest interest to pay to the lenders, and that could also deter investors from investing in the company. So I tend to stay away from companies like this because the company not only has done poorly profit wise for the past 3 years, but it also is highly leveraged. So those are two very, very negative barriers. So let's get into the last of the financial statements, that being the cash flow statement. Let's see if the company can redeem itself by proving positive. So the net change in cash, that being the bottom line of the last financial statement, is 6.808 million for the last financial year, and for the previous financial year it was 268 million, and for the previous it was negative 99 million. So there's quite a lot of volatility. So the thing with net change in cash is it carries over to the next financial year. So whatever the current net change in cash is a consequence of the prior the net change in cash of the prior financial statements. The prior cash flow statements. So the net change in cash for 2019 is negative 99 million. So it had a negative 99 million euro net change in cash. So it was negative that amount, and the next financial year it managed to gain not only 99 million to make it a net €0 net change cash, but also had a positive 207 million euro market cap. Net change in cash. 268 million. So if you add those together, that's about 367 million euros of additional cash that the company has managed to attain to be able to get to a positive net change in cash of 268 million euros. And if you go to the last financial year, the company managed to wipe out 365 million euros of cash. I wouldn't say it's necessarily wiped out. It's probably been used in some ways to maybe clear off some debt. Let's just actually quickly check the last cash flow statement to see. So we start at the top line. The net income is a starting line, and it started off, as you see, the last year was 268 million, and it started off this year with a net income of 230 million, and the company managed to gain 127 million euros in cash from operating activities. That being divided up into 160 million. Sorry, I'm going to skip that part actually to focus on the other broader aspects. So let's just quickly read through that. Changes in working capital, from investing activities. So the cash from investing activities was negative 152 million. The capital expenditures was negative 169 million. So that's taken yeah, so the capital expenditures was 169 million, and the other investing cash flow, so it gained 17 million in cash flow from investing activities, and it spent 169 million euros on capital expenditures. Maybe that might be to buy some capital plants and equipment. The financing activities divided up shows that the retirement of stock is worth 371 million. That being the retirement of debt, sorry. So getting rid of, eliminating debt, which is a very smart strategy on behalf of the business to do. It was to clear off 309 million euros worth of debt. So that took out 309 million euros of cash. So the foreign exchange effects of that was 31 million. So it lost 31 million euros in that regard, but it still ended up with a positive net change in cash, sorry, of 6.08 million. So overall, I think the company made some quite wise decisions retiring some debt. And I will definitely be interested in the next year, or in the current financial year statements, especially the cash flow statement, to see what the decisions that the executives of the company have made and will make to increase the financial attractiveness of the company, specifically with regards to how they manage cash flow. Without further ado, thank you for watching this video. I will see you in the next one. If there are any thoughts that you have with regards to criticism of the video and how I carry out the video and how I present the videos in this series, please comment in the section below, because I am definitely interested in your thoughts and opinions, so I can provide a more suitable presentation and present my videos in a more suitable and attractive way to you as viewers. But without further ado, I am going to close the video, and I will see you in the next one.